Well, Pandora is expected to go public tomorrow, and the internet radio company is counting on investors to ignore 10 years worth of losses. Pandora boosted the size of its IPO by 43%. That's part of what Alan Patricof calls a feeding frenzy for a limited number of consumer-related tech companies. Alan's a venture capital pioneer. He's been doing it for 40 years and has backed companies such as Apple, AOL, and Office Depot. He's here with us in studio this morning. Alan, welcome to InBusiness.
Thank you for inviting me.
You know, just as recently as April, we were talking to people in Silicon Valley who said no need to rush to IPO. There's plenty of cash, there's plenty of capital to be raised outside of the public markets. What changed?
Well, there's not a lack of capital outside the public markets, but what's happened is that we had the LinkedIn public offering, followed by Fusion, and now we have all the excitement around Pandora, Groupon, and Zynga's right in line, and I'm sure there are a few other very select companies that are in the queue and that will have a very good reception. Noticeably, almost all of them are consumer related.
No, fair point. It's not as simple to call them tech. But was LinkedIn really like the litmus test? In other words, had the reception not been as strong as it was, albeit with a small float, would we have seen the brakes put on these other planned IPOs, like the Pandoras, like the Groupons?
Well, you have to understand that a company like LinkedIn and Pandora and Groupon have millions of subscribers, millions of people who've signed on, so that there's an enormous awareness. I noticed in the paper just today that LinkedIn, after it went public, has had a big increase in the number of subscribers. So I think that's really a big part of this.
Raising awareness of the brand?
Yeah, as opposed to if it were a business-to-business company, you know, which may have 50 or 100 or 200 customers, it doesn't have the same awareness that those companies do around the country or around the world, frankly.
Now, the comparison's often made to what happened, you know, with the tech bubble, that perhaps companies were too quick to go to market before they actually had proven business models. You look at like a Pandora that's coming out tomorrow, and they've lost $92 million since 2000. It's unclear how profitable they can actually be. What is your take versus what you saw happen in the dot-com years? Is this a fundamentally different world?
Nothing is fundamentally different, and I've lived through several of these cycles. I think this really is different, although we are seeing a certain degree of overexuberance, I think, at the moment. But what's different is that all of these companies, no matter what you want to say about the valuations and the excessive interest, perhaps the heightened frenzy, they're real companies. I mean, they have real revenues, they don't have profits necessarily, and they have lots of users, and those users are increasing. And what the public is excited about is growth rates. And these growth rates for all the companies we've been talking about and that may be prospectively coming, there's a very large growth rate. And we used to always say that a company would sell at a premium to its growth rate. And we're talking about rates of 30 or 40% a year. So you can see why there's so much excitement. People are extrapolating what they think is going to happen in 2012 and 2013.
It's a bet on what might be, and cash in search of growth along those lines. But
and then these companies are spending money to build up their user base. So that's why their earnings temporarily may be I don't want to say understated, but are held down by their deliberate attempt to put more money into marketing and grow their user base.
Well, talk to me about what this means for venture capital, because you know, up until recently there hadn't been a lot of exits because of market volatility. I know you have been concerned about the cost of listing yourself here in the United States as a publicly traded company. What is changing for venture capital firms now?
I wish I could say there's been a dramatic change. There really isn't. We're talking about a very small part of the overall venture capital universe. I mean, there may be 1,000, 2,000 companies started in a year, and we're talking about a handful of 6, 10, at most 15 companies that have this kind of exciting frenzy around them. Most companies that are venture-backed will never go public in the environment we have in the world today. They will end up in some kind of corporate M&A transaction, and that's the reality. because the underwriters aren't there to take the companies public, the market makers aren't there, the valuations that are needed in order to be a public company today run $250 to $300 million as a minimum. And you know, of the thousands of venture-backed companies, not too many get through this minefield of that kind of valuation. And I think that the ones that are getting through are ones that have gotten those valuations with real revenue growth, and you know, we'll see what the profits grows. And I'm sure there's going to be some excesses. I mean, we've already seen some of these things going public and declines after the first day frenzy.
You're talking about LinkedIn?
One of those where, you know, the high was what, 120 and it's selling at 75. So someone's a loser, although it's double the initial public offering. So they've got to have to find their own level.
Now, do you think, though, that you've been concerned about Sarbanes-Oxley and some of the pressures at the cost of becoming publicly traded in the United States? Do you expect to see a migration to the Hong Kongs of the world? I mean, listing happening outside the U.S.?
I don't think that's going to be a major trend. I don't want to overdo the cost. The cost element is one, including more important are some of the other factors I meant about what it takes to get through to become a public company. And so a lot of in the 90s, late 90s, that wasn't the case. You could go public with a $10 million offering. You could go public if your valuation were $30 or $40 million in total.
So does this make the VC world more dependent still on the giants? If you're not going to exit as a VC firm through an IPO, you've got to sell your company to a Microsoft, to a Google.
Absolutely. You can name the 10 or 15 buyers. Just like I said, the 10 or 15 who are going to get public. You can name the 10. And by the way, some of those companies that are going public may end up being some of the buyers.
So don't count the old guys out there.
They'll have paper to deal with, public paper to deal with, and they'll have plenty of cash. So we may have a whole new group of buyers for some of these young companies. So it's a good time for venture capital, I will tell you that.
It's good to hear you say that, Alan. Thank you for coming on and telling your story.